the bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
Right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Carol Massar, live from the Milken Institute Global Conference in Beverly Hills. We're counting you down to the close. Just about 2 minutes to go here. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. There was a lot of green on the screen heading into that Fed decision at 2 p.m. Eastern. A lot of red on the screen now that this decision has been made.
Yeah, and we're still continuing to see worries in terms of some of the regional bank stocks. What I find fascinating, Romaine, we've been talking so much leading up to this meeting, and after all is said and done, ultimately the Fed is still data dependent. Yes, maybe a hawkish pause, but nonetheless, do they think that they could potentially have to do more? They could.
A hawkish pause. Are you trademarking that? Because I think Jay Powell made it clear they're not pausing.
No.
He said that really wasn't the discussion today, or at least no definitive agreement was made today. But he did make it clear that was on the table for the mid-June meeting.
Well, and pauses were talked about by the Fed members,
yes,
even though they said not for this meeting in particular. And I do feel like, once again, we got kind of the initial statement, and maybe there was a thinking, okay, a pause more likely. And then once you got into the press conference and Mike's question, a different feel.
Well, it was a different question, and a good question. But here's my question to you, Carol.
Yeah.
What is the case for a pause? Because if you say they're data dependent, I'm looking at ADP data we got this morning, big jobs report this weekend. We've seen other data here. That's not the inflationary, the deflationary environment that he's looking for.
Absolutely, and he also said 2%. That's our inflation target.
Yeah.
Asked about.
Did you hear when someone asked him about 3%?
And he said,
he said, we ain't dropping the toolkit at 3%. Are you crazy? He didn't say, are you crazy? But that was what he had in his eyes.
And the inflation that he really looks at. You have that kind of mind meld with Jay Powell, apparently.
Carol, I mean, I do think, though, that the market reaction is interesting.
Yeah.
Believe it or not, the market reaction, I do think, was a little more subdued.
Absolutely.
Even though we did erase all of those gains. But the idea here that we've really been in stasis for quite some time. You can see those numbers on your screen right now. I know Scarlet Fu is back in our global headquarters in New York with a better read here on where we stand right now with the closing bell. Scarlet.
Yeah, let's take you through the closing numbers here. We have the S&P 500 losing 0.7%, the Dow coming in off 0.8%, and the Nasdaq losing 0.5%. The Russell 2000, actually the lone gainer here, gaining 0.4%. When you look at the industry performers here in the S&P 500 by 24 industry groups, it's overwhelmingly red. There are 4 sectors that did finish in the green, but by and large, it's due to a couple of individual names. Autos like Tesla and Ford did particularly well. You also have commercial and professional services. This is Verisk Analytics, which provides data to the insurance industry, as the big winner. And then Whirlpool and Garmin helping lift the consumer durables and apparel index, and a couple of biotech names as well. But on the downside, Yum and Starbucks helping drag lower the consumer services companies. Energy companies also losing 1.9% on the drop in oil prices, as well as the banks index losing 1.7%, as you guys were just discussing. All right, let's get to Qualcomm's results. This is the chip maker based in San Diego. Second quarter adjusted EPS of $2.15 matches the average analyst estimate. In terms of revenue for the period, $9.27 billion is better than the expected $9.09 billion. When it comes to its outlook, the third quarter revenue forecast is anywhere from $8.1 billion to $8.9 billion. That is a big miss from the expected $9.25 billion that analysts were forecasting. And so what that indicates is that the smartphone slump will continue to drag on. In terms of adjusted earnings per share for this quarter, Qualcomm sees $1.70 to $1.90. Analysts were looking for $2.20. So while the second quarter numbers look like a beat, the third quarter outlook is where Qualcomm falls short, and you're seeing the stock extend and deepen its losses right now. And after hours trading, losing about 5% right now. Carol and Romaine will continue to keep an eye on what's going on with these after-hours stocks. Back to you.
A good reminder, of course, that this market isn't just driven by the macro, Carol. It's also, of course, driven by the micro. Those earnings still coming in. But tied into that, of course, is overall economic conditions, business conditions. We talk about the banking sector, whether there's going to be a retrenchment in lending. Powell came out. Remember, he said, let me start here first, addressing the banking sector. In his words, it's sound, but he also made it clear the FOMC, the policy members, did have a pretty interesting discussion about the risk posed.
No, absolutely, which is really interesting. And I think that kind of mirrors some of the conversations that we've heard here, and certainly from the private credit area or private lending area, that they are seeing an uptick in demand because banks are holding back. Powell talked specifically, talked about credit tightening impact and how that will definitely have an impact on the economy. And I think it just reminds us that we are not sure if we are out of the woods yet when it comes to pressures, but we are definitely seeing the slowdown in lending, right?
Yeah.
And that is going to impact the economy and the slowdown.
Well, it'd be interesting, though, but is that going to be a contraction in lending or just a slowdown in growth? Because he was asked about this. He mentioned the senior loan officer survey,
right,
which comes out next week, which presumably they would have a little insight into prior. And he said that growth has slowed, but he also said it's still lending growth is still growing.
He said he didn't think recession, right? Also,
yes,
in general, but he said he wouldn't necessarily rule it out as well, which I really feel like he's really reminding us that they're going to be looking at the data.
Right.
And I also thought it was interesting that he said he didn't agree with some of the Fed staff in terms of their economic projections.
I thought that was interesting.
Yeah,
that's not abnormal, we should point out. We've seen this in the past.
Yeah.
The staff is usually a little bit more aggressive.
But they were the ones that kind of planted the rate cuts, right, early on.
Yes.
And which he quickly kind of smacked down when Mike McKee asked about it, saying we don't think that that's appropriate considering our inflationary targets.
Right, but then, and it gets back to that dual mandate, which is really 3 mandates, but everyone says dual mandates. But the idea here that is their focus.
Right.
He's been challenged on this so many times. I mean, we talk about coming into today, that letter that was sent out by Senator Warren and a few other Democrat lawmakers basically saying you need to stop this, not necessarily because of the data being dependent, that the idea here that there is economic pain out there that maybe isn't showing up in that data and they need to be mindful of. He said, look, I see the pain, I feel the pain, but we got a mandate and we're going to stick to it.
You know, both of us are talking to John Hope Bryant, which is something that he works with financial literacy and really helping folks get into homes that couldn't otherwise tap into the financial system. He's going to talk about, that's one of his concerns. These higher rates are certainly making it more difficult for individuals, maybe with lower incomes, to get into homes. So he understands the pain. Jay Powell understands the pain, but it doesn't sound like he's going to back off of it, right?
Yeah, it doesn't sound like it. I am curious. Let's push ahead a little bit.
Okay.
We have a jobs report on Friday. Right. I think next week we get another CPI data. And we still got a long way before we get to that mid-June meeting. Earnings season, I mean, I know we have a couple big names next week, but we're kind of almost through it, at least as far as the big cap names
tomorrow.
here. What's the catalyst for this market?
What is the catalyst for this market? I mean, I think, we're going to get back into another round of Fed speak, right? So how do they manage in terms of some of the data points that come out until that next Fed meeting? That is certainly something that can control what we see in terms of the trade. I think that's some of it. I mean, the sentiment in the market's still expecting rate cuts at this point.
Yeah.
To some extent. We'll see if that changes.
Yeah.
We've seen it over this year go from aggressive expectations about Fed rate increases to all of a sudden talking about rate cuts, which just says to me that things can swing pretty rapidly.
And we should point out, I mean, being here at Milken, which is dominated by a lot of folks in the world of private capital, we know that the reactions we're seeing in the public markets are a little bit different from the reaction here. I remember when the statement came out right here, this was a crowded room behind us as everybody was on their lunch break here. Wasn't a lot of reaction.
No.
And when I went up and asked people about it, it was kind of a shoulder shrug. After the press conference, same thing. It's this idea, obviously a lot of folks here have a much longer view, but I've also heard from a lot of folks who are saying, hey, I can live with 5% or 5.25, whatever we're at now right now.
Yeah, I mean, we've had worse, certainly, in this in this
And that's what they all said. A lot of these people in this room, they started their careers during the Volcker era or right out of that era when they were used to double-digit Fed funds rates.
Yeah, exactly. I think of Mike Milken and some of his, folks that he worked with at Drexel. I mean, they have seen a lot of different market cycles, a lot of individuals. The one thing I will say, and I don't know if this has come out, Romaine, in your conversations, that a fair amount of the market guests are saying one of the things you need to think about is the lag effect in terms of Fed policy. Jay Powell talked about it today, and certainly the impact that has on slowing things down, maybe causing more of a credit crunch, tightening, things up,
the lag effects of Fed policy.
The lag effect of Fed policy. And that
what about the lag effects of the banking crisis? Because so much of the focus is the rates going up. Now, some would say that feeds through to the banking crisis, but the crisis isn't over.
I agree with you, and I think we have to be very quick and smart, that we don't just say, okay, one and done. JP Morgan, First Republic, look at Western Alliance today.
People did that in 07. People did that in early 08.
I know, but again, folks are saying this isn't 08.
No, it's not. It's not, and no one has said that. But everyone has pointed out there are parallels there when it comes to that lagged effect. The idea that the first shoe to drop really isn't the one you have to be worried about. It's that second shoe to drop that rattles the market.
What's your net takeaway on the Fed?
My net takeaway on the Fed is that he has done, Carol Massar, exactly what he said he set out to do. And I think that he may be serious that a pause is in effect.
I think he's still data dependent. We will see. All right, guys, that's a wrap for Romaine and me from the Milken Institute Global Conference. We're, of course, Romaine's going to go off to do some things. I'm going to head back to New York, but that'll do it for our cross-platform coverage. Beyond the Bell, we will see you again, same time, same place tomorrow. Not same place, different places.